My name is Torris. I am a senior contributor for Crowdund Insider, which is a publication out from the US publishing on everything related to alternative finance, property finance, consumer lending, SME lending, and trade finance. And today I have the pleasure of having with me Faes from LendInvest and hopefully Bruce Johnson from PeerStreet. It's a very interesting panel first because I think we as individuals, we all love real estate, you know. As investors, as borrowers, we all dream of real estate. We are very attached to that product. So I will ask Christian to introduce himself and LendInvest.
Yeah, good morning, everyone. You've only got half the panel, so I'll try extra hard to make it interesting. And I'll never let Brew live this down, that's for sure. Yeah, so I'm Christian Faes, co-founder of LendInvest. We're a UK marketplace platform focused on property finance. As a marketplace, on the borrower side, we focus on the specialist mortgage market, so short-term mortgages and development finance, and then most recently buy-to-let. So any sort of specialist mortgage borrower we can service. And then on the investor side, we have a whole universe of investors. So from individual investors can invest in a retail bond program that we've listed on the London Stock Exchange, through to sort of large institutional investors that buy our loans directly, including the likes of Citibank, Nomura, HSBC, and so on. So a full-service marketplace, lending a little over £1 billion a year at the moment, and we've been going, so this is our 12th year, so we're sort of a relatively mature business, but I guess we still very much think of ourselves as a startup.
Okay. So alternative finance is not so much alternative nowadays, it's becoming mainstream. Who are your borrowers and how do you recruit them?
Sure. Recruit's a nice way to put it. I guess our borrowers are what we describe as property entrepreneurs. So they transact quite regularly. We like to think of them as property professionals. So certainly on the short-term mortgage side, if we look at that first, they're buying properties, they're renovating them and either selling them or holding them in a portfolio. And on the portfolio side, we now lend to them as well. So they may be just property investors that have large portfolios of properties, generally doing it on a full-time basis, generally operating in a certain sort of geographical part of the country in the UK. They sort of know the market really well. In terms of how we go about recruiting them, well, it's a very intermediated market in the UK, so mortgage brokers play an important part of us recruiting them, I guess, in the first instance. But through technology, trying to sort of build a direct relationship. So servicing the brokers in an easy way and sort of making it just easy for them to transact with us, get a transaction done, and then ultimately build a relationship with our end borrowers as well.
Mm-hmm. So you started out, if I am correct, with bridge loans, and you are in a real estate development. It's a faster moving part of the property finance business, and it's also a recurring part. So I assume that's why you chose this path of going from bridge loan to real estate development at large, and now you're moving into mortgages.
Yeah, I mean, I guess for us, there was never really a grand plan around it. I mean, we saw, in 2008, we saw the disruption that was happening in financial services across the piece. In the short-term mortgage space, like pretty much every short-term mortgage lender got wiped out, bar sort of one or two. And they didn't get wiped out necessarily because of the credit quality of their loan books. It was because they typically had one bank funder. So I think we saw what we thought was an opportunity to try and bring private investors into the asset class. And then over time, the sort of institutions have got back involved. But for us, it's to have a really diverse and resilient funding base. The other side of it is it's a pretty good return. So certainly, 2008 through to sort of 2013, 14, investors could get a really good return secured against real estate. Double-digit returns certainly, in high teens in many instances. So we thought it was actually just a good asset class from the investor side, and there was demand on the borrower side, so it kind of made sense. Over time, yeah, they've got more institutions involved with the funding base, and so we have been able to move more into the mainstream mortgage market. So about 2.5 years ago, we started in buy-to-let, which is our first sort of 30-year mortgage, a very mainstream proposition, rates from like 2.8% per annum. And for us, I think that's obviously a less attractive asset class for individual investors. No one wants to invest for 30 years and get a 2.8% return, but certainly institutions like it. And then we're moving into the securitization market and so on. So for us, it's a natural evolution for the business to get to where we are here today.
Mm-hmm. I like this expression that you used, there was no grand plan. It seems to me that there was pretty much a grand plan, because you're one of the few fintechs that have been profitable from quite a long time.
Yeah, we have. So we've been profitable for the last 5 years. I think in the early days, we were less tech-enabled, so I guess we were less interesting to VC-type investors. And so for the first 7 years, we bootstrapped our business. And so I think that sort of tough grind meant that the DNA of the business is always about sort of watching every penny and trying to sort of just be self-sustaining, because when we got to that point, we could sort of carve our own path. And I think now we feel quite fortunate that we can do that. We have subsequently raised VC capital, and they've been hugely supportive of us. We haven't spent that money, actually. So by the time we took VC capital, it now just goes as kind of lending capital. Here he is. Whoa. Yeah.
No problem.
We're pretty much out of time.
Glad I can make it for a little bit.
Yeah, so I'll maybe let Brew have a chat.
But I'm not letting you off the hook.
Oh, okay.
Because Christian just said at the beginning he had no grand plan, but he had a grand plan because he has a very profitable business. And now you talk about your sources of funding, and they're very diverse. Could you give us an idea of the distribution of, you have some qualified investors, you have some institutional investors, and you have these bonds. Could you break it down for us?
Yeah, so I think it's important for us to try and have every possible type of investor to be able to invest in the loans that we originate. So increasingly, we think retail investors going through a retail bond program is best for us. But over time, I guess like a lot of marketplace platforms, and certainly it was more in the States. Brew could probably talk to you, but it started as the concept of being individuals investing, and then over time to sort of scale a business, you realize you need institutional capital. Mm-hmm. Through the process of that, you need to institutionalize your business and sort of get it ready for institutional capital. I think over time it will increasingly be that way. So we did our first securitization last year. We'll be in the market shortly doing our second securitization. That's kind of the next evolution for us, and then we'd like to get pension funds and sovereign wealth funds and all the rest of it. So I think we're just getting started, but we're a long way advanced to sort of institutionalizing the capital base.
And I'll continue with Christian, because then we will contrast the two businesses in a very interesting way, And so you are a marketplace, matching borrowers and lenders. And you told me that you have no intention to becoming a balance sheet lender. Is that the case, and why?
So we have no intention of becoming a bank. Okay. We do have some balance sheet exposure in the loans that we originate. So I talked before about having raised some VC capital. We do provision that and have sort of skin in the game with some of the loans that we originate. In terms of being a bank, that's not something for us. And actually, we think part of the core value we've produced is actually being able to scale the business without being a bank. I mean, the only reason we'd want to become a bank is to get cheap capital. The pricing on our first securitization, and you could sort of pay first time you do these things, it's cheaper than what we would be taking deposits as a small deposit-taking bank. So actually, I think when our capital base now is cheaper, or certainly on the way to being cheaper across the piece, than what we would be if we were a bank. So I think why would we take on all the regulatory overlay and the sort of compliance and all the sorts of stuff that would constrain the business? For us, it's about building technology, staying ultra efficient, and then sort of continuing to drive down that cost of capital in different ways.
Very good, thank you. So, Brew, you had time to take your breath. Thank you very much.
I apologize.
Oh, it's not easy to find your way through the Paris FinTech Forum. We have a lot of understanding. So, Brew, what is really interesting is that LendInvest is originating the loans directly. is an originator, whereas in PeerStreet, which is an equally successful property finance business, is not. So can you explain the context and why you work in a different, on a different business model than LendInvest?
Yeah, and I think and that was a very good description, and I think the main differentiator of our business is a lot of similarities between our businesses, both where the capital comes from, how we plan to scale, the asset class we're dealing in are very, very similar. The main differentiator with our business is in the United States, where we're focused, there's a huge amount of fragmentation on the lending side of the business. And there's, I mean, thousands or tens of thousands of different types of lending businesses, a lot of small lending businesses that focus on the type of loans that Christian makes at LendInvest that we make in the United States. And so instead of being a direct lender, our idea on our business is let's create a platform for small originators, provide technology, provide the regulatory overlay, provide all the standardization, and then basically aggregate up supply from these smaller lenders and make it available to investors. So where Christian and LendInvest go out and directly lend to borrowers, we don't acquire borrowers. We basically acquire them through a distributed network of small lenders. So think of our clients. Currently, we have about 250, 300 small LendInvests that we provide software to aggregate up their loans, diligence those loans on behalf of investors, and then make it very homogenized and easy to invest in.
Mm-hmm. And you're providing to this fragmented market of small lenders access to a capital that they would never have access to. Can you elaborate on that, the type of investors that you're able to attract?
Yeah, so that's correct. And so we had a theory from day one that there's a lot of lenders that make good loans, but they may not have access to capital. And vice versa, while these lenders may be making good loans on a small scale in their local communities or local markets, it was very difficult for them to access capital. And so by being an intermediary between those two parties, you give investors access, then you allow them to diversify broadly across loans, which obviously reduces risk. You provide them data to further reduce risk, but then providing that capital to those lenders is really important. And so previously, to access the capital markets or worldwide or any investors, normally these small lenders would have individual relationships with individual investors and a small group of investors. We basically first step, similar to Christian, first step was we aggregated up a bunch of individual retail investors that allowed them to invest through a platform. And then we could distribute that capital to these small lenders. Then as we've grown and gotten larger, with scale, you bring in, it creates opportunities. So we've now went from going from individuals to hedge funds. Now we're at the bank and insurance company level, and in the future we would like to get to pension funds. So the benefit to that is you get larger, you get scale, you drive down the cost of capital and provide more capital to these small lenders so they can go make more loans in their communities. Now prior to PeerStreet, these lenders could never access a European bank or Blackstone. They're just too small. And for us sitting in the middle and creating standardization, it just allows both sides of the parties to transact kind of freely with only one counterparty, and that's PeerStreet.
And for the investor, it's a huge diversification opportunity.
That's right. That's right. I mean, last year we did just under $2 billion of loan volume. And I mean, for instance, like a large asset manager like Blackstone, it's very difficult for them to get access and diversification to these loans as well, in addition to individuals. So it's an interesting thing. It's the same type of benefit that applies to individuals: access, diversification, and then hassle-free management of the loans because of all the software that we provide and how we service loans and just do distributions. The same benefit applies to institutions as well. So.
I love you, bro, because you speak so fast. You're making up the time.
Oh, sorry.
No,
I'll try to slow down. I'm nervous.
It's perfectly clear.
My calendar had us at 12:40. That's crazy.
Just making a bit of fun of the situation. But so, joke apart. What is really interesting to me is that you were both in real estate development financing, and you as well are moving towards longer-term mortgages, which seems to me to, I really wonder why, the risk is different. Why are you doing that? Are you copying LendInvest?
I mean, I just follow everything this guy does, It's like I've got an appointment with the wig maker. I'm going to have a nice some hair, too, later, It's just, I love this guy. No, Well, so we just believe that in the mortgage investment world, it's in the United States, one of the largest asset classes in the world is the mortgage securitization market, which is investing in mortgages. And that, quite frankly, almost all of the bond markets and the securitization markets, there's a huge amount of intermediaries in that market, but also there's a lot of third parties that are necessary to create bonds and to allow investors to invest. And then there's asset managers that charge fees to investors and do all these things. Well, we believe that a lot of those, there's two things that a platform can do. You can disintermediate intermediaries, but actually more importantly, you can replace a lot of third-party service providers with technology and be able to do things more efficiently and better with lower errors. And if you do that more efficiently, there's a huge amount of the cost structure that could come out of the system and then get distributed to the real stakeholders, which are the borrowers on one side, and the end investor, which the end investor is pension fund holders and retired people that have money sitting in a bond fund and things like that. And so the concept of whether you're in a short-term rehab or fix and flip loan, which was where we started, a 12-month loan, or a 30-year mortgage, the same thing applies, that you can use technology to do things better and more efficiently and then distribute the value out to the ecosystem, which is the real goal. And so we've always had the goal of, let's start with the short-term loans, because that was the most fragmented and the previously hardest to access and had this kind of weird best risk return profile. But once you get enough technology and create efficiencies, well, then there's no reason not to move into different asset classes. And so that's what we've started to do. And quite frankly, our institutional investors, they want more assets because they use our platform. It's efficient for them, and we basically attracted them using these short-term loans. But they say, okay, we like what you're doing. What else can you go then access for us? And it creates a positive, a virtuous cycle. And the network effects are very positive in that a small lender who previously made only 12-month fix and flip loans because his cost of capital was too high to make other loans. Well, he has the same relationships with borrowers who want a 30-year mortgage or a 30 or a longer-term rental loan. And so now we can say, hey, lender X, you have proven that you have a good track record. You know what you're doing. You know how to acquire borrowers. You know how to underwrite loans, and you can grow your business. All of a sudden, here's a new product that you can offer in your community to your borrowers. Well, that's a win-win, we think. And so the idea is just continue to we think in the future, every type of real estate loan should be invested through the platform. Now, for us, we have two investor bases. We have individual investors and we have institutions. In the current market, no individual investor wants to be in a 30-year loan, at least in the United States. So we only sell the longer-term loans to institutions. But our goal is to create liquidity for every investor so that individuals can also invest in any duration loan, but be able to trade in and out or get liquidity in and out of those positions. And when we move to that stage, like Chris was talking earlier, how the evolution went from individual investors to institutions and then getting them to pensions and sovereign wealth funds. We're seeing the same evolution, but we actually think in the future that then it actually comes back to more retail investors directly, because if you can get liquidity, we think basically investors can start looking at getting in fixed income debt and moving in and out of it as a replacement for bank account, basically. So almost look at it as a deposit alternative in the future. But
we have a few minutes to conclude. Christian, where do you see yourself in 5 years? Now you are the chairman of LendInvest. So where do you see LendInvest in 5 years? And what do you think will continue to be the core of your sustainable competitive advantage?
A big question. So I think hopefully just doing more of the same, really. So I think we'll continue to evolve the business. In the buy-to-let market, we've got quite a lot of runway. I mean, we aspire to be the biggest mortgage lender in the UK, which I know some people sort of scoff and think that's ridiculous, but we're a lot bigger than what we were sort of 5 or 6 years ago. We're doing £1 billion a year plus now in a market of 300 billion. So we've got quite a lot of runway to keep evolving the business. In terms of competitive moat, I mean, there's no mortgage lender of any sort of scale that has built technology from scratch in the last 4 or 5 years servicing customers. So I think what we have is truly valuable. It's very sticky in that, and we're seeing that with repeat customer rates. I mean, last year, just to give you an example, about 70% of our customers that we lent to, we'd lent to before. So they come back to us, and they're coming back to us at a quicker pace as well. So I think we just continue to evolve the business, try not to get too caught up in the hype, and just chip away at it. Yeah.
Brew, in 30 seconds, where do you see yourself in 5 years?
In 5 years, we want to be the largest marketplace and platform for real estate debt. And when we think of marketplaces for
in the
real
US.
estate, in the U.S. I look at the largest marketplace for real estate debt being Fannie Mae. I look at them as a marketplace in the United States. They buy loans and sell loans into the bond market. They have 25% of the traditional mortgage market. That's kind of like, that's our goal.
And
we kind of target
better job
those.
than Fannie Mae.
We do it differently, but in the future we think we could do a better job, or basically create value for them so they could do their job better, basically by using our technology. Yeah.
Thank you so much.